Imagine a country that has conquered the moon, a place where humans dare to dream the greatest dreams. Yet, right within that very society, withdrawing a few dozen dollars from your own account becomes an almost impossible task unless it is during regular bank business hours. While technology has taken humanity to the moon, the ability of millions of American citizens to access their money remains tightly bound by rigid, outdated rules. Picture the everyday life of Americans in the mid-23rd century. Bank branches only opened from 9 or 10 in the morning until 3 in the afternoon, Monday through Friday. No weekend service, no after-hours transactions. Workers often had to take half a day off on payday, stand in long lines under the blazing sun or pouring rain, or reluctantly ask grocery stores, supermarkets, or even bar owners to cash their paychecks for exorbitant fees. This traditional banking system had operated smoothly for decades, without any automated technology, like a machine deliberately designed to maintain order and control. And from this very paradox, three big questions force us to pause and reflect. Who truly controls American citizens' access to their own money? Why does a nation that always prides itself on technological pioneering and the value of individual freedom turn the use of personal assets into a privilege reserved only for those who follow the bank's schedule? And more importantly, how has the 24-hour convenience we now take for granted quietly transformed the power relationship between the individual and large financial institutions? This is not simply a story about machines or convenience. It is a long, silent struggle between the bank's control over the time and space of citizens' deposits and the genuine desire for freedom in using the very money one has earned. Banks do not just hold your money, they also hold the right to decide when you can touch it. To understand why, it was not until the late 1960s that America began to break those traditional banking hours. We need to go back in time to the original design of the retail banking system after the Great Depression. It was a design built deliberately on the foundation of personal trust, strict human supervision, and intentional restrictions to prevent any sudden withdrawals. From here, we will see more clearly the true nature of power behind rules that seem to be nothing more than daily habits. You see, American financial history is not just dry numbers. It is full of dramatic stories about power, control, and the longing for freedom. If you are diving deeper into the secrets behind the monetary system, please hit the like button on this video and subscribe to the Financial State Secrets channel right now so you do not miss the next analyses. Together, we will explore how that original design actually operated. After the initial analysis of the power paradox, let us take a deeper look at the foundation that shaped the entire American retail banking system. When the country had just survived the devastating storm of the Great Depression, with thousands of banks collapsing and images of desperate people standing in long lines to withdraw money still haunting everyone, leaders decided to completely rebuild the financial structure. The supreme goal was absolute stability and preventing any repeat of panic. It was in that context that the Federal Deposit Insurance Corporation was established to protect depositors and restore shaken confidence. At the same time, strict legal regulations, including the McFadden Act and individual state laws, strongly reinforced the unit banking model. Each local bank almost held a monopoly in serving the surrounding community with clear restrictions on opening new branches. This design was not accidental. It aimed to protect small banks, maintain stable money flows within communities, and prevent mass withdrawals that could push the system into a new crisis. The core philosophy behind this model is profound and worth pondering. Policymakers and bank leaders believed that every cash transaction needed to occur under direct human supervision. The presence of staff not only helped minimize fraud, but also nurtured close relationships where people knew each other's faces and circumstances. Moreover, after closing, banks needed quiet time to manually check and balance the books. Those short opening hours, which usually ended early in the day, were therefore not a sign of laziness. They were a carefully calculated risk control mechanism that helped banks maintain liquidity and avoid unexpected fluctuations from customers. Imagine how this system operated every day. People mainly withdrew money through tellers using passbooks or personal checks. The entire payment flow depended heavily on checks with enormous volumes requiring careful and labor-intensive processing. Meanwhile, the Federal Postal Savings System provided a safe option for those who still distrusted private banks. With modest interest rates but government guarantees, it became a reliable refuge for many families. However, it did not fully replace regular banking services, and gradually lost its role as confidence in commercial institutions grew stronger after the war. In addition, grocery stores and supermarkets unintentionally became unofficial sub-banks. They cashed paychecks for customers, charged a small fee, and created a parallel support network that helped workers overcome the limitations of the official system. Viewed objectively, this was entirely a deliberate design, not the result of stagnation or lack of creativity. By restricting easy access to money, the designers significantly reduced sudden liquidity pressure while strengthening the position of local banks in controlling community money flows. Banks at that time were not just places to store assets. They were the gatekeepers of time, deciding the pace at which every citizen was allowed to use the very money they had worked so hard to earn. From this solid yet controlling foundation, we will see more clearly the real benefits, as well as the hidden cracks when the old system operated at its peak. From that tightly designed foundation, the traditional banking system operated smoothly and reached its peak during the prosperous post-war years. At that time, most Americans still lived in an economy where cash played the central role. Wages were usually paid in the form of paper checks or directly in cash, making access to money an indispensable part of daily life. Imagine a typical payday. Long lines of people crowded in front of banks or flocked to supermarkets to cash checks. Some branches began experimenting with drive-up windows, allowing customers to conduct transactions without getting out of their cars. Even so, everything remained strictly bound by fixed schedules with not a single minute of flexibility. To help you feel the full weight of that reality, let us talk about a typical factory worker in the Midwest. He finished his shift in the late afternoon, long after the banks had closed. He was forced to wait until the next morning or take half a day off and accept losing part of his wages. In emergencies, he had to ask the grocery store to cash his check for a significant fee. For housewives managing the entire family's spending or night shift workers, arranging access to money became a complex puzzle that required careful planning over many days or even an entire week. Nevertheless, we cannot deny the real benefits this model delivered. It offered highly personalized service. Tellers knew their customers understood their habits and circumstances, which helped minimize fraud and build deep trust within local communities. The system also maintained considerable stability. Banks tightly controlled daily cash inflows and outflows, avoiding sudden liquidity fluctuations that could endanger both the institution and depositors. Moreover, this model effectively protected small banks from competitive pressure by large financial institutions in big cities, helping preserve diversity and cohesion in the national financial system. However, behind that appearance of stability and reliability, the inherent limitations gradually became clear. The system unintentionally created significant inequality in time. People with stable jobs and standard business hours could access services far more easily than shift workers, busy farmers in the fields, factory laborers, or poor residents in urban areas. Banks were indirectly putting a price on customers' right to access their own money according to a schedule they themselves set. Real power lay in the ability to decide when and how each citizen was permitted to use their own assets. When the old system reached the peak of its stability, profound changes in American society began creating pressures that could not be ignored. The middle class grew strongly, accompanied by women's increasing participation in the workforce. Rapid urbanization and the expansion of suburbs increased the geographic distance to traditional bank branches. At the same time, the volume of paper checks surged, demanding enormous costs in staff and processing time. The economy no longer operated within business hours. With more flexible work shifts and a faster-paced life, everything seemed to run without stopping. In response to these changing needs, some initial reform efforts were tested, but most ended in failure. Notably, there was the initiative by Luther Simjian, who installed deposit and check machines that operated day and night at several branches of major banks in New York. The machines were equipped with cameras to photograph receipts, aiming to build user confidence. However, the devices did not attract a large enough customer base and quickly proved commercially unsuccessful. Simjian later shared that mainly a small group of people who wanted to avoid direct contact with tellers used the machines. This detail reveals a deep psychological barrier. People were still not ready to fully trust technology when it came to money, their most valuable asset. Meanwhile, similar experiments in Europe, such as paper ticket cash machines in Britain, had not yet crossed the Atlantic to American shores. The country maintained a certain distance from the trend of automating retail banking services, clinging to the familiar human-based model. Day by day, conflicts between the parties involved became increasingly evident. Big city banks longed to expand services, cut staff costs, and compete through superior convenience. In contrast, small banks and local associations worried about losing control, losing close customer relationships, and gradually shrinking market share. Unions representing tellers feared mass layoffs, and ordinary people increasingly expressed frustration with the rigid schedules, while the life around them demanded far greater flexibility than ever before. Looking deeper, these tensions did not simply stem from technical issues or operating costs. They represented a sharp collision between a model created to deliver stability after crisis and a new social reality. In that society, each individual's time had become more valuable than ever, and the economy operated non-stop. The tightly controlled, step-by-step model had begun to reveal its limits. The need to find an automated solution became urgent, not merely a trend, but a historical necessity. From these ever-widening cracks, a major turning point was about to emerge that would forever change how Americans interacted with their own money. From the ever-widening cracks and the increasingly urgent need for automation, a historic moment arrived that permanently changed the landscape. At a bank branch in Rockville Center, Long Island, New York, Chemical Bank installed the DocuTeller machine, developed by DocuTel. This was the first automated teller machine in the United States to use a reusable magnetic stripe card, allowing customers to withdraw cash without any interaction with a teller. The person behind this turning point was Don Wetzel, a former professional baseball player who was then serving as an executive at DocuTel. The idea came from his own deeply frustrating real-life experience. During a lunch break one day while standing in a long line at a bank in Dallas to withdraw money, Wetzel suddenly realized how absurd the situation was. He quickly collaborated with two talented engineers, Tom Barnes and George Chastain. In just about 1 year, the team perfected the machine. The cost to build each unit reached around $30,000, a significant amount that even exceeded the annual salary of an average teller. With strong determination, Chemical Bank launched a confident advertising message declaring that from now on the bank would open at 9 in the morning and never close again. At first, the machine only supported basic cash withdrawal functions and had not yet incorporated many complex features. Public acceptance was also quite slow because old habits remained strong. Nevertheless, the most important thing had happened. The psychological barrier that banks only operated during business hours was decisively broken. Looking deeper, we can see the key reasons that made this turning point possible. Magnetic stripe card technology combined with smaller, more compact computers had reached maturity, perfectly aligning with the intense competitive pressure between banks. This was not merely a technical advance. It was the moment when control over time began to shift from financial institutions into the hands of ordinary citizens. The immediate consequences might still have been modest, but the symbolic value was extremely powerful. Your money was no longer bound by a schedule set by others. For the first time, real freedom in time to access personal assets became a concrete reality. After that breakthrough moment, the change spread rapidly and more widely than anyone could have imagined. The number of automated teller machines gradually increased across the United States, from the modest initial figure to thousands of units. Citibank took the lead, with massive investments, building a dense network in New York. Then came a severe snowstorm that forced many banks to remain closed for several days in a row. ATM usage surged by about 20%. It was from this event that the campaign "The City Never Sleeps" was born, turning nonstop service into a clear competitive advantage and helping the public gradually become familiar with and trust the new technology. Important milestones continued to appear, perfecting the system. Multifunction ATMs were introduced, allowing more types of transactions. Shared networks between banks were established, giving customers greater flexibility regardless of which bank they used. Drive-up windows were also widely deployed, bringing convenience closer to busy lifestyles. Later, when regulations allowed service fees to be charged, the number of machines grew rapidly and became an indispensable part of daily life. To clearly see the transformation, let us objectively compare the two systems. The old system maintained tight control from the bank's side, requiring users to pay the price and significant waiting time, but in return, it built deep personal relationships and managed liquidity risk effectively. In contrast, the new system delivered genuine time freedom to each individual. Operating costs for banks dropped sharply because each machine transaction was far cheaper than one handled by a live teller. The number of tellers at each branch tended to decrease, while the total number of branches increased, thanks to lower costs and changes in legal regulations. Overall, employment in the sector did not collapse suddenly, but was maintained and even temporarily increased due to network expansion, before gradually adjusting as digital banking developed fully. The most profound shift lay in the relationship between citizens and financial institutions, as well as the state. Money was no longer bound by the fixed hours of any organization. However, power had shifted cleverly. Those who controlled the machine network's transaction data and fees now held greater influence. The convenience we enjoy was exchanged for banks collecting and analyzing far more detailed information about each person's spending habits. This was a major transition from control through time and space to control through data and sophisticated algorithms. Overall, the journey from the old system to the new one brought real freedom to millions of people, but it also opened new questions about power and responsibility. All of this leads us to profound philosophical lessons for today's era. From the profound changes we have just explored together, one core lesson emerges clearly. Access to cash has never been purely a technical issue. It has always reflected the fundamental question of power. Who decides when and how citizens may use their own assets? The old system placed top priority on stability and the control capabilities of financial institutions. In contrast, the birth of the automated teller machine brought time freedom to each individual. But it also opened the door to new, more sophisticated forms of control through transaction data and vast connected networks. Viewed in a balanced way, we cannot deny the enormous value this technology has delivered. It truly liberated millions of workers from rigid schedule constraints, especially shift workers, the growing number of women joining the workforce, and residents living far from traditional branches. At the same time, it marked the beginning of a massive transformation in the banking industry, moving from close personal relationships to machine-based and data-driven interactions. This process helped accelerate the decline in the role of physical cash and paved the way for a more modern financial system that is also full of challenges. Today, debates surrounding a cashless society, central bank digital currencies, and the protection of financial privacy are updated versions of the same questions that existed since the 1960s. As paper money is gradually pushed to the margins, the old question becomes urgent again in a new form. Who will control your access to money when there are no more paper bills or automated teller machines? Who decides when, where, and under what conditions you are allowed to spend? History teaches us that every convenience comes with a price in terms of power. Understanding how monetary systems were designed and operated in the past is the key to ensuring we are not caught off guard by the changes taking shape right now. Let us maintain a spirit of vigilance, continue asking deep questions, and strive to protect our right to free access to our own assets. If you want to dive deeper into the hidden power struggles behind the American monetary system, please continue the journey with the Financial State Secrets channel. Together, we will explore historical secrets and valuable lessons for the future. Thank you for listening. Please like this video if you found it useful, and subscribe to the channel so you do not miss the next episodes.